Another YouTube video for my channel, Anglo-Sax. In this three-part series, I'm going to be breaking down the forecast for pound USD. Just to let you know, like if you hear my voice being a bit croaky or a bit, if it starts to kind of crackle just a tad, I'm trying to overcome a recent cold that I've had over the Christmas period. So my voice, I do apologize, might come across quite croaky, but just please bear with me as I get this content out there today. So if you're new to this channel and you've come across this content for the first time, it would be great to get some comments and some thoughts if you watch the video. If you find it helpful, I'd be more than happy to hear from you. And also, as always, please feel free to like if the video is relevant to you, and also to subscribe if you like this type of content. So my YouTube channel is fairly new. I've been putting a few videos together over the last coming weeks. So during December for different forecasts on the USD CAD and also crude oil. Please feel free to check those videos out. The USD CAD has been moving, very bullishly over the last week or so, week and a half, and the crude oil has been moving bullishly also. So please feel free to check out those forecasts. They're still underway. I've completed my three-part series for the USD CAD, and there's still another series. There's still another video that I need to record for the YouTube for actually crude oil. Okay. So without further ado, we're going to get straight into this video, and currently we are on the line chart, and I'm just going to give just a bit of a backdrop as to what has recently happened here for this price move, for this push higher on the pound USD. So first things first, I'm just going to get rid of that for a second so it doesn't get in our way. At the beginning of October, we saw this really big price push up from this downtrend. So this market, this pair had been in a downtrend since July. So for the whole of the summer period, we had this leg down, big leg down, and then we saw how the market put in a bottom at the beginning of October. So at the very beginning of the month, market starts to trade higher, push higher, and then it drops. And it starts to accumulate throughout the month of October. Going into November, we see that push up, and then a continuation throughout November and December. And one of the things to highlight here is that I'm just going to put my annotations on the chart here. So I'm going to take off this so you can see. And there we go. Some magic appears out of nowhere. And throughout this video, I will highlight more in terms of what these horizontal lines represent, but they kind of speak for themselves. You can see this annotation here, it just says key level. So what we had is, I'm going to now return to a candle chart. So what we had in October is we had the price find some relative support above this key level. Okay, so above $1.20, the market begins to build up some support. So we don't quite get down into this key level, but we trade at midpoint, and that's what this is here, this 121. We find support around this 121 area, and then we start to trade higher after this downtrend. So the market rallies for a few days, trades up, gets above this opening, this key level here, this 122, and then we drop down into this key level. Okay, and then what happens is between this key level and this midpoint, we get the price starts to accumulate up and down, up and down, up and down, up and down, and then we get a massive surge on the 2nd of November, again at the beginning of the month in November, big surge here, and then a big surge here, okay, reaching higher, pushing higher. So what we can see is that this move that we've had, this push up has been formulated through this accumulation phase here, this accumulation phase. So the market, and this is very important, that the reason I'm highlighting this is because it's going to make sense in a moment when we drop down into a smaller time frame and I begin to unpack my forecast for the pound USD throughout the course of January. Okay, so we've had this accumulation phase on a daily time frame before the market rallies and it breaks out of this accumulation phase. So we have this accumulation phase. Let's just take another tool here, and we'll mark this up like this. Okay, so we have this accumulation, this channel, this sideways trading before this move happens. Okay, so we have this back and forth accumulation, price is trading up and down, up and down. So it's not going up, it's not going down, it's just accumulation. And it's finding support at this midpoint level, this $1.21. Find support. So we close above it here, we trade up, and we close above it here, 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 here. We're closing above this level, and then we rally, we push through 1 day, 2 day above this key level, this 122. Okay, and then the move happens. So I'm just going to get rid of these annotations. So what we've had is that price move for pound USD, that rally higher, it's happened now. It's over in my book, in my opinion. This rally is over. And my understanding, my view on the pound USD is that this rally from here all the way up to here, it was over at the beginning of December. This price run had come to a climax at the beginning of December. But what we've had, and I'm going to break it down in a moment, is we've had similar to what we had previously. So we've just looked at this area here underneath this key level and at this midpoint. And if we go up here, we can see on the daily, same type of behavior. Okay, so we're seeing price close below this key level and also this midpoint. So it's almost an inverse situation in terms of what we see. We see it here, key level and this midpoint, price is accumulating. And what do we have here? We have this key level and this midpoint, price accumulating. So it's almost the inverse of what we've seen already. Okay. So what that does for me is that, so we've got it here, here, closing above, closing above, closing here, closing above, and then bang, 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 bang. Okay, and then just to make it more cleaner, we can just probably take out this tool here and put this here, bring it across, and it's almost an inverse situation as what we've seen below. So the law of correspondence states that as above, so beneath, as above. So we've seen it here, and now we're seeing it here. And it's very important to acknowledge that, because in the Forex market, there is, a perception of discrete time series. That's what we're dealing with when we're looking at these charts, whether it's commodities, whether it's Forex. What we're analyzing is discrete time series. And within a time series data set, there is periodicity, where there is patterns of repetition. So it's repeating phenomena. So things that repeat themselves for a frequency through time. Okay, and that's what's happening here in my understanding, in my study, in my research, in everything that I've in every way that I've applied myself to these financial markets. What I understand is that patterns and behaviors repeat themselves over time, and sometimes it can be a year, sometimes it can be a day, sometimes it can be a week, sometimes it can be a quarter, sometimes it can be a month, sometimes it can be 3 years. The point being made is that it's reoccurring. So it is frequency, and where there's frequency, there's repetition. And that just goes to the laws of nature. There's nothing in this life that isn't repetitive. Waking up in the morning, going to bed, it's repetitive. Going to the gym is repetitive. Eating food is repetitive. The sun rises, the sun sets, it's repetition. And it's the same in this marketplace. It's all repetitive, it's all repetition. It's just understanding what's happening at what time. And when you understand what's happening at what time, you should be able to take advantage of the opportunity that presents itself at that time, at that moment, at that distinctive point. And what goes up must come down. You know, just the laws of gravity right there. So the market's traded up. Now it's going to trade back down, according to what I believe, according to my understanding and my forecast, and just showing in price this behavior that we've already seen down here. It's the same type of behavior. We had a day down. We've had, you know, it's not a like for like, but it's very similar in its frequency. Very similar in its frequency. It's all manipulation. All of this was all accumulation, and this, as well as we drop into a smaller time frame, you'll see is accumulation. So something's going to break. Something's going to give way very soon. And my forecast is that price is going to move lower. We're going to break down here at 126 and get to 125 and potentially down to 124 across January into February. So I'm going to drop down into a smaller time frame. And just before I do that, I'm just going to highlight just quickly some of these annotations on my chart just for clarity. So literally it's very straightforward. It's just key levels. So we have a range here of 200 pips, and then we have a mid-range, a midpoint. Same here, 200 pips and then a midpoint. We have 200 pips. I haven't put the midpoint here in here yet because price is way up here, but I do have it here. We have 200 pips and then a midpoint, and then I have this here, which is a 3-month high. This is the midpoint of the 3-month high, and this is the low of the previous 3-month high, because the way my model is calibrated, it's set up on a 3-monthly candle. And you know, I'll go into more details in future videos, but I just look at the market over a 3-month period. And that's just because of business in terms of quarter by quarter, so 3-month by 3-month cycles. And you know, the Forex market is a business, and there are businesses out there that trade the Forex markets, the institutions, the financial institutions. They're a business, and they're in here to make money, and they have to submit quarterly reports, annual reports, and etc. So it makes sense for me to look at the Forex market from a business standpoint in terms of wholesale prices. Where are they moving the price? Where is the price likely to draw to in terms of liquidity? And what is the market showing me right now at this particular point in time? Okay. So basically that's all that represents here. This red line, this horizontal red line, this midpoint here, and this vertical line here, it just represents the beginning of that 3-month candle. So now we're in a new 3-month cycle starting from January. So January, February, March is going to be a new 3-month cycle. And that's why I'm forecasting lower prices, because the market, this particular instrument, has something to trade back down towards, and it's going to be these levels. It's going to be the liquidity that's resting below these lows. So we have liquidity resting above old highs here. That liquidity, all the liquidity was taken out here. Liquidity is going to be resting above here, and we also have liquidity resting below old lows here, because they've pushed the market up. So stop losses are accumulated here, 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 relative equal lows here. Again, I'm speaking very fast here, but there's liquidity resting below here. There's going to be liquidity resting below here, and all in these candles. And the market trades to liquidity. It seeks out liquidity. And if you're a trader, you know this. So, you know, we're just talking hex here. But if you're not a trader or you're new to trading, then it's an important concept that you need to master and understand. So I'm going to drop down into a 1-hour chart. I've highlighted my annotations. I'll try to do that in most videos. So I've just mentioned the idea of liquidity. So I'm just going to expand on that just a little bit more very briefly. So like I said, we have, when we're taking trades, if we're selling at market price. So let's just say, so at the moment, this horizontal line is the last close here. This 1.27. That's where the market closed on Friday here, and this line just represents that, and it's just something that you can set automatically on TradingView just to see where price is. you know, trading each day, and it just helps me to see where the price is, just the price line. So let's just say I was looking to sell this market on Tuesday, so Tuesday of last week, and I wanted to sell this market. Let's just say I wanted to sell this market midpoint of this last up close candle. So this candle here. So I'm thinking, okay, I expect this market to trade lower, so I'm going to set a buy stop. So that means while the market was trading up here, let's just say on a 5-minute time frame or a 50-minute time frame, as the market begins to trade down into this candle, on this candle here, let's just say my order was here, right here, and I said, okay, I want the market to tag me into the trade at this point, and my stop loss is going to be above here, or my stop loss is going to be 10 to 15 pips above this high or above this high, okay? So the market trades down, it tags me in, it keeps me going. Let's just say my profit target is somewhere down here based off liquidity that's resting in these candles here. So I'm going to get out somewhere down here. I've got a nice range. I'm going to get out somewhere down here, and my stop loss is up here. So on that day, Tuesday, I was very, very successful, didn't take a loss, and I was able to, you know, take some good profit out the market here because I got out, let's say I got out down here somewhere, okay? So the point that I'm making is that if my stop loss is resting above here, then there are going to be other players in the market where their stop loss is resting above these highs as well, right? The guys that have large capital to play with, hedge funds, you know, financial institutions other than banks, so non-bank financial institutions, pension funds, asset managers, all those guys that are in the market, large retail traders, they're going to have their stop loss. If they're bearish and they're expecting the pound USD to fall in value, then their stop loss is going to be placed above this high, this high, this high, or even these highs. And what that does sometimes in the market, it creates this phenomena which is equal highs, okay? And this horizontal line that I've got marked up on my chart with this syllabus and the syllable here, EH, it just means equal highs. So that EH just means this is a horizontal line where the market has created equal highs. And as you can see, here we are, highs, highs, and it just means the market hasn't traded up into this area, and it's created this equal high phenomenon. And the market doesn't like that type of behavior. It doesn't like, it's too clean, it's too perfect, okay? So the way in which these markets work, because it's the way in which price is delivered, you know, to the market, it's on a program, okay? And that program will remember where it's come from, and it's gonna trade back up at some point to offset this imbalance here that we have, okay? This phenomena which we call an imbalance. It's too perfect, it's too clean, the market hasn't had chance to trade up, and it makes sense. It hasn't had the opportunity to trade up into this region to offer the other side of the market, okay? So it hasn't had the opportunity to offer buy side. It's just been all one way. And if that word buy side, if you're not familiar with that, in future videos I am going to break down a lot of my terminology in these videos that I'm putting out there at the moment. Okay, so that's what I have marked up as a potential range. Okay, so we did have a situation on Friday. We had economic news, and the market did try and trade right back up to take out this liquidity, to offer opposing liquidity, which is the buy side, but they failed to do that. But they did try really hard. They tried to get up here and just trigger those stop losses, okay? So just to turn our attention to that, so that's one area, and as above, so beneath, so the law of correspondence, equal highs, EH, EL, equal lows. So there will be an area here where these are relative equal lows, and there's going to be stops that are resting below here, okay? Whoever was buying here, the stop losses were taken, because this market took the stop losses and it reversed. So it took liquidity that was resting here and reversed. but it didn't manage to get this low here, didn't take out this low, and it's now kind of equal to this low. So there's still a pool of liquidity resting. There's still stops resting down here, and the market didn't reach down to take all of the liquidity. It reversed. So it took what was ever resting in here, all these stops, and then reverses, and then tries to take out this liquidity here, and it fails. So what my expectation is, we may get a price run above here just to offset this imbalance. And there's an area here as well that's imbalanced, where price hasn't had the chance to trade back up into this midpoint of this candle. So that may happen going into the week. So what we might see is the high of the week on Monday or Tuesday or even Wednesday. But once that high has been formed, what we should anticipate, what I'm looking for, is prices to begin to break down. And for me, this area is the great opportunity to short this market. Anything above 127, in and around 127 and below 128, I want to see price begin to break down, and I'd like to see the price action with a lot of volume, a lot of magnitude moving down away from this key level, okay, and taking out and also filling all the imbalance that's been left in this trade, this push, this large institutional push higher. And I'm just going to quickly jump to the weekly and just show you. Excuse me. So I'm expecting all of this candle to be filled with another bearish candle going into the new week, okay, because it's just a massive imbalance here. And to me, it's all manipulation. So just going to go back down to the 1 hour and just going to highlight what I mean by the manipulation is just all of this. It's all accumulation. And I expect this. This is what my expectation is. And I'm just going to draw out this little tool here. Just to give much more clarity, we can see that we have that technical price action pattern. It's bearish. It's not, in fact, I'll take that back. It's not 100% bearish. It's just accumulation. It's just consolidation. And I'm expecting all of this to play out in a way where price gets back down to this level here, and it starts to fill this void here, this big gap where price hasn't had the opportunity, just holding, it's just sitting around there it's just sitting there waiting to drop. And that's what I'm waiting for. And my areas of interest are going to be selling above this key level, and once price drops below this key level, is looking for more selling opportunities around this level as well. So between 26 and 27, I'd like to see price give me opportunities to sell short back down into this level. Take that off. So hopefully that just clarifies everything in terms of what I'm looking for. I'm not bullish, I'm bearish. Trading the pound USD going into January, I'm very, very bearish. And I'm expecting to see, or I'm forecasting bearish price action based off the structure of the market, where the market has come from, the logic in terms of what I can see, how we're not trading higher anymore. We're breaking down below this key level. We looked at the daily chart and we saw the accumulation that was instrumental taking this market higher, and we're seeing the accumulation again here, same type of accumulation, for this time in the reverse direction. So we've seen it down here for the market to move higher, and now we're seeing it above here for the market to move lower throughout January, okay? So this is the first part. This is part 1. There'll be a part 2 and a part 3 of this series. And what I'm expecting is a weekly bearish candle to formulate from the new trading week. So the week commencing the 8th of January. If you're wondering what this is just opening price at 12 a.m. So I've got my clock set to New York time. I'm based out of London, UK, but my TradingView charts are set up on the New York time. There's reasons for that, but again, I'm not going to go into all the reasons for that at the moment. So I think for now, this is my forecast on pound USD. This is what I'm looking for. I will release part 2 and part 3 throughout the course of January. It might be next week, actually, part 2 next week. We'll let the week go by, see how the market's trading, and I'll update my channel on part 2. I'll make part 2 hopefully at the weekend, just to see how the forecast is panning out. On the flip side, just quickly, we've had a strong dollar. So if we're going to have a weaker pound, we need to see a stronger dollar, and we can see from the end of December, we've had a stronger dollar. Dollars rallied, and we had that same type of manipulation play again on Friday because of the economic announcements that came out with non-farm payrolls. Massive imbalance here for the price to trade back up into that. So I'm watching the dollar index very closely with the pound USD, but I'm not going to give my full analysis on the dollar index yet. I'm just expecting a stronger dollar, weaker pound going into January. So I think that's all for now. From me, from this part 1. Like I said, if you come across this video, you watch this video for the first time, please feel free to like if you like this content, and to subscribe and hit that notification bell for future videos. Helps the channel, inspires me to keep creating this content, and then in future videos I will begin to break down more of my trading model and some of the angles in which I'm able to look at price. You know, for me, it's all about the angle in which you're looking at the market, and share some of my trades, and maybe in the future, maybe be running some live sessions, and you know, all good stuff to come in 2024. But without further ado, I'll see you in the next video.